Margaret spent 34 years teaching 6th grade in the Chicago suburbs. She retired at 67 with a fully funded Illinois teacher's pension, $58,000 a year. She had a financial advisor she had worked with for 12 years. Before she retired, they sat down and went through everything: investment accounts, Medicare timing, Social Security strategy. He told her she was in excellent shape. Margaret paid $5,800 in Illinois state income tax on her pension that first year, and the year after that, and the year after that, because nobody told her that 3 states in this country would never touch that income at all, not a dollar of it. Not her advisor, not her accountant, not her union. 18 months ago, Margaret moved to Tennessee. Her state income tax bill that first year in Tennessee, $0. Same pension, same $58,000, same woman, different state. Right now, thousands of retirees are making this exact calculation quietly, without announcing it, without their advisors ever bringing it up. They are leaving 5 specific states and moving to 3 specific states. And the difference in what they keep versus what they send to their state government is not small. Robert is going to show you exactly which 5 states they're leaving, exactly which 3 they're moving to, and exactly what you need to do if you want to make the same move. 18 months. That is all it took for Margaret to go from $5,800 in annual state income tax to $0. Over a 20-year retirement. That is $116,000, and that is before accounting for investment growth on the money she now keeps every year. This is for informational purposes only and not financial, tax, or legal advice. Please consult a qualified professional for your specific situation. My name is Robert Paz, too. 0S, your guide to the retirement tax moves most advisors never bring up. If this is helpful, hit subscribe. Robert covers the state tax and retirement income strategies that most financial advisors never volunteer. And drop your current state in the comments below. Robert will tell you exactly where your state falls on this list and which tax haven makes the most sense for your situation. Today, I am going to walk you through the 5 states retirees are quietly leaving, what each one costs them, and why. I am going to show you the migration data, because this is not a theory. This is already happening at scale. And I am going to break down all 3 tax havens, what they actually offer, what the trade-offs are, and the one step most people skip that can cost them everything if they do it wrong. Here is something that surprises most retirees. Federal income tax gets all the attention. IRA withdrawals, Roth conversions, RMD planning advisors talk about federal tax constantly, but state income tax on retirement income is often larger, harder to avoid, and almost never discussed. Why? Because it varies so dramatically by state that advisors in high-tax states tend to just treat it as a fixed cost of living there. It is not on their checklist to tell you that the state next door has a different answer. Here's what state income tax actually touches in retirement: your pension, your IRA and 401k withdrawals, your Social Security income in some states, and in many states, even your investment income. In a state like Illinois, Connecticut, or Minnesota, the combination of these taxes can remove $5,000, $6,000, or even $7,000 a year from a middle-income retiree's budget money that was supposed to cover healthcare premiums, home maintenance, or travel. And unlike federal tax, which you can reduce through Roth conversions and careful planning, state income tax on a pension is often simply, you live there, you pay it, there is no workaround. The only workaround is the state line. State 1, Illinois. Illinois taxes all income in retirement at a flat 4.95%. Pension income, IRA withdrawals, 401k distributions, all of it. There is no senior exemption. There is no age-based income exclusion. If you have a pension of $58,000 and IRA withdrawals of $20,000, Illinois takes 4.95% of every dollar. That is $3,861 on the pension alone. Illinois also has some of the highest property taxes in the country, the second highest effective property tax rate nationally as of 2025. So you are paying state income tax on your retirement income and one of the highest property tax bills in the country on your home. Retirees with paid-off homes in the Chicago suburbs frequently pay $8,000, $10,000, even $14,000 a year in property taxes. State 2, New Jersey. New Jersey taxes most retirement income. It offers some pension exclusions for lower income retirees, but for anyone with a household income above $100,000, those exclusions phase out quickly. New Jersey also has the highest average effective property tax rate in the nation, consistently above 2.2%. A $400,000 home means $8,800 a year in property taxes before any exemptions. Combined state income and property tax burden for a typical middle-income retiree in New Jersey can exceed $12,000 annually. State 3, Connecticut. Connecticut taxes, Social Security income above certain thresholds, taxes, pension income, and taxes IRA withdrawals. It also has an estate tax with a lower exemption than the federal level, meaning some estates that avoid federal estate tax still owe Connecticut. Property taxes run high as well, particularly in Fairfield County. Connecticut loses more retirees to Florida than almost any other state. State 4, Minnesota. Minnesota is the only state in the Midwest that still fully taxes Social Security benefits at the federal rate. The state conforms to federal inclusion rules without any additional exemption. It also taxes pension income and IRA withdrawals at rates up to 9.85% for higher earners. For a retiree drawing $80,000 in combined income pension plus IRA, Minnesota can take over $5,000 in state income tax. Cold winters and high state taxes are a difficult combination to defend. State 5, California. California taxes all retirement income pension, IRA, Social Security included for higher earners at rates up to 13.3%, the highest state income tax rate in the country. A retiree with $100,000 in retirement income in California could owe $6,000 to $9,000 in state income tax depending on deductions. California also has a significant cost of living premium on housing, health care, and general expenses. Many retirees who built careers in California and own paid-off homes are now doing the math and relocating, keeping the equity, changing the address. This is not a theory. The IRS publishes annual migration data by state. It shows exactly how many tax filers moved from state to state each year and what their income was. The pattern over the last several years is consistent. Illinois, New Jersey, Connecticut, Minnesota, and California are all net exporters of retirees. They lose more high-income taxpayers than they gain. Florida, Tennessee, and Wyoming are net importers. The flows are accelerating. Between 2020 and 2023, Florida gained more than 200,000 net new residents per year, many of them retirees from northeastern high-tax states. Tennessee saw a 20% increase in in-migration. Wyoming, a smaller state, saw its retiree population grow at nearly twice the national average. This is not anecdote. It is capital flowing toward better tax treatment, and it is happening without most financial advisors ever mentioning it to their clients. Tax haven number 1, Tennessee. Tennessee has no state income tax on wages, salaries, pensions, or IRA withdrawals. It had a tax called the Hall income tax that applied to dividends and interest that was fully repealed in 2021. As of today, Tennessee collects zero state income tax on any form of retirement income. A retiree with a $60,000 pension and $25,000 in IRA withdrawals pays nothing in state income tax in Tennessee. The same income in Illinois costs approximately $4,200 a year. In California, it could be $5,500 or more. Tennessee also has no estate tax. Property taxes are below the national average. The effective rate statewide runs around 0.64% compared to New Jersey's 2.2%. The trade-offs: Tennessee does have a sales tax. The combined state and average local rate is among the highest in the country, around 9.5%. For retirees who spend heavily on goods, this partially offsets income tax savings. Tennessee also does not have Medicaid expansion, which matters for retirees on fixed incomes who may need long-term care planning. Cities like Nashville, Knoxville, and Chattanooga offer warm climates, strong healthcare infrastructure, and growing retiree communities. Cost of living is significantly lower than the northeastern states most retirees are leaving. Tax haven number 2, Florida. Florida is the most well-known retirement destination in the country. For good reason. No state income tax is written into the Florida Constitution, making it extremely difficult to change. No tax on pension income, IRA withdrawals, Social Security, or investment income, and no estate tax. Florida also offers a strong homestead exemption, $50,000 off assessed value for primary residences, with an additional up to $50,000 for seniors over 65 who meet income thresholds. Property taxes run around 0.89% effective rate statewide, lower than the national average for what you get. The trade-offs are real. Florida's housing market appreciated dramatically after 2020. And home insurance. Costs have surged in many coastal counties due to hurricane risk. Some retirees are seeing annual insurance bills of $4,000 to $8,000 in coastal areas. Inland counties like Polk, Lake, and Marion offer significantly lower insurance costs with the same tax benefits. Florida's healthcare infrastructure is strong. It is one of the most Medicare-friendly states in the country, with high concentrations of specialists and facilities in major metros. For retirees leaving Illinois, New Jersey, or Connecticut, Florida is the most direct trade. Similar infrastructure, dramatically different tax treatment. Tax haven number 3, Wyoming. Wyoming is the least talked about of the three, and for some retirees, it is the most powerful option. Wyoming has no state income tax, no estate tax, no inheritance tax, and some of the lowest property tax rates in the nation. The effective rate is approximately 0.55%, the fourth lowest in the country. A $400,000 home in Wyoming costs roughly $2,200 a year in property taxes. The same home in New Jersey costs $8,800. Wyoming also has no tax on retirement income of any kind, and it has strong asset protection laws that matter for retirees with significant investment accounts or business interests. The trade-offs are geographic and lifestyle-based. Wyoming is sparse, cold, and far from major coastal population centers. It does not have the healthcare infrastructure of Florida or the cultural offerings of Tennessee's cities. For retirees who prioritize outdoor life, hiking, fishing, skiing, and want the most favorable tax treatment available in the United States, Wyoming is difficult to beat. For retirees in California specifically, Wyoming is the most common move. The tax differential for a Californian with $120,000 in retirement income can exceed $10,000 per year. Here's the step most people miss, and it is the one that can undo everything if you do not do it correctly. Moving to a tax haven state is not enough. You have to establish legal domicile there, and your old state will come looking if they have reason to believe you still live there. Illinois, New Jersey, California, and Connecticut all have residency audit programs specifically targeting high-income taxpayers who claim to have moved out. California's Franchise Tax Board is particularly aggressive. They will look at where you received medical care, where your car was garaged, where you voted, where your close contacts live. Domicile is established through a combination of actions. You must register to vote in the new state, update your driver's license, change your address with Social Security and Medicare, update financial accounts and estate documents, and spend more than 183 days per year in the new state. This is not complicated, but it is specific. And if you miss the documentation, a residency audit from your old state can claw back multiple years of the tax savings you thought you had captured. The safe approach: work with a tax professional who specializes in residency changes, ideally one licensed in both the old state and the new one. The cost is typically $1,000 to $3,000 for the transition year. It is worth every dollar. Margaret did everything right. She moved in October, spent her first full winter in Tennessee, updated every document. She filed her final Illinois return as a part-year resident. Tennessee's Department of Revenue did not send her a single piece of correspondence because Tennessee does not have a state income tax department looking for her. Her first full year, $0 in state income tax. Her pension check does not change. Her IRA withdrawal does not change. The only thing that changed was the state line she lives on the other side of. Over 20 years at $5,800 per year, invested at a conservative return, over $200,000 that stays in her portfolio instead of going to Springfield. Her advisor never brought this up. He still has clients in Illinois who have been paying that same bill for a decade. You do not have to wait for your advisor to bring it up. You know about it now. If this helped you, hit the like button. It takes 2 seconds, and it helps more retirees find this information. Subscribe if you have not already. And if you know someone in Illinois, New Jersey, Connecticut, Minnesota, or California who is retired and has never run this calculation, send them this video today. Pause 2. 4S today. Drop your state in the comments. Robert reads every single one. If you are already in one of the 3 havens, tell us how it went. And if you are still in one of the 5, it is not too late.